how to invest in real estate for rental income in Nigeria, plus one sure real estate investment trust stocks to buy. In this video, I'm going to show you how to invest in real estate. I'm going to show you the easy way to tap into opportunities in real estate and still earn the same rental income that you had wished you could earn if you own a physical property. If this is the first time you're watching my video or visiting my channel, kindly hit the subscription button, turn on the notification bell so that when I release interesting and insightful video like this, you will be among the first to get notified. Now, what kind of properties are we talking about? Here are examples of properties you can actually own. Here, you can be a part owner of shopping mall. You can be a part owner of an estate, either family office space. Office space. You can be the owner of a student hostel, whatever property type that you are interested in. This particular video will show you how to co-own or how to be a part owner of properties across Lagos and also in Nigeria. So these are examples of properties you can co-own. You can be part of an office space. You can be part of a major mall, whatever it is, as long as it falls under real estate, you will definitely be a part owner. So in this video, I'm going to show you how to actually start building assets, how to start building your portfolio, how to start building your investment exposure in real estate without actually being involved in the whole process of buying a land, building, getting approval. And then at the end of the day, you're still going to earn the same rental income as that person that had actually gone through the whole process of buying from scratch, building, and then renting it out. So disclaimer here, whatever I share in this video, they are based on my personal research and calculation. Kindly do your due diligence and make sure you look at the companies that I'm recommending right now, if it fits your investment profile. And then please make sure that you vet my recommendation based on your risk profile too. So let's get started. So what are the things that you're going to learn in this particular video course? Now, first one, you're going to learn what the average yield on property is versus inflation. Now, why is this very important? Before you can start investing in any real estate company, either physically or via the stock market, you need to be sure that the real estate company is very profitable. And how do you know whether it's profitable? You need to know what the average yield is across board, average yield in Nigeria, average yield in Lagos, but I like to use Lagos. So if I understand what average yield in Lagos is, then I want to be sure that whatever real estate company I want to invest in, their yield must be above, at least must be within the average or above the average. Any real estate company that is giving me yield below the average, then it's a problem. And number two, I'm going to talk about why co-owning real estate via real estate investment stocks are actually very good. Now, many of us are complaining we don't have the money, we don't have the capital, but you do forgot that you can actually leverage the stock market to be part owner of good real estate company. You can actually be a real estate investor through the stock market. So these are the things I'm going to talk about. So the model here is to co-own properties. That means instead of starting from scratch, looking for where to buy land, looking for where to build, you can actually go to the stock market and look for real estate company, look for thriving real estate company that will give you the same income you would have earned or the same rental yield you would have earned if you had actually buy physical properties. And guess what? You might talk about capital appreciation. Yes, there is also the capital appreciation gain in this model. So everything you would expect to benefit from real estate is also applicable right here. And then I'll also share some of the advantages of co-owning. When you co-own, you can really exit and enter. But then when you want to buy physical properties, the process, the due diligence, approvals, and everything required. But that doesn't mean that physical property is not okay. But then I'm talking about the easier way. So when people ask me, real estate or stock, which is better, I tell them both of them are okay. However, you can even leverage on the stock market to actually invest in real estate, because in the stock market there are many companies listed in that market. So what do? You can actually be a part owner of a company in oil and gas, in real estate, in retail and manufacturing, in insurance, in banking sector. So if real estate is part of it, that means you can also be a real estate investor as a stock trader or as a stock market investor. So the third one is I will now teach you how to select a profitable real estate stock that will last and reward you in years to come. This is very, very important. Don't just go to the market and pick random real estate company. In short, what I'm going to share with you right now, you can even apply it to physical properties, or maybe when you have a deal or someone is approaching you to invest in their real estate company and then they are promising you certain return. I've seen that play out where they will pay easy buy and pay back or cash back, whatever they call it, where they will say, oh, bring 1 million, collect 40% in the next 1 year. Now, the model I'm going to show you right here will show you how to screen the real estate company and check if they are actually genuine or if they are truly profitable. Don't look at whatever they are generating, whatever they are telling you, oh, in the next 10 years, this asset will go up. I'll show you what to watch out for and then how to request for their book. When you request for their book and they're able to show you this thing and then you can do your calculation, then you'll be confident enough to say yes or no when it's time for you to take your investment decision. So let's move to the first one. What is the yield? What's the average rental yield? Why is this very important? Before I invest in a real estate company, first I want to be sure that the company is generating return that is actually above yield. What is rental yield? Rental yield simply is the rental income divided by the property value. So if you invest in a property worth of 10 million and then you're collecting 2 million per year as rent, then your rental yield will be 2 divided by 10. It's as simple as that. And when you say 2 divided by 10, your yield is almost 20%. Now, there is a research that was carried out some months back regarding rental yields in Lagos. And that research, I am giving credit to gifted analysts for that particular research. So this is it right here. So it's asking how profitable, it was asking how profitable is Lagos market. So when I went through this research and then he was able to arrive at different rental yield, you can see rental yield right here. Rental yield is the average rental value divided by the property value. And this is very important that when you are before you invest in any real estate company. So here he did a calculation. Now the rental yield at Ikoyi, 5.3, Banana Island, Victoria Island, Southwest, Lagos Island. Now, what does that mean? It means that if you're going to buy properties in this island zone one, and then you are expecting rental income, then you should be looking at 5% of whatever you have invested in. You should be looking at 4%, 4%, 4%. So if you have invested 100 million and 10% of 100 million is 10 million, then 5% will be around 5 point something million. You can imagine 5 point something million at the end of the year for putting 100 million in a property. So that's what this tells you. It gives you an idea of what you should be expecting when you invest in this different area. Now, for Island Zone 2, you can see 6%, 6.3, 6.3. So that's what you should be expecting at the end of the year. Meaning when you calculate whatever you have incurred and then you're looking at what your rental income will look like, then this is what you should be looking at: 6%, 6.3, 6.3. That's from Chevron Agungi to Lekki Phase 1. And then Island Zone 3, you have 4.4 Aja, Sangotedo, Lakowe, Awoyaya, 4% range. And then from mainland, 4%, Suledi, Bagada, Yaban, Ilupeju, average of 4%. And then Island Main 2, where you have Papa, Isolo, First Tax, and Wordofin, 4.85, 4.32, 3.68, 3.17, respectively. And then you have your mainland 3, Maryland, Ikeja, Alausa, and Alausa and Ikeja. The first Ikeja is GRA, then 4.4, 4.3, 3.9. So you notice something that the rental yield on mainland is very low compared to the island. Island gives you an average of 5 to 6%. Mainland will give you around 3 to 4%. So here 3.5 for 3.2, 3.1, and then 3.1. This is Ogba, Magodo, GRE1, GRA2, and then Ogudu. And then that's just it. So what does that mean? This research actually helps me know what the average rental yield is in Lagos. So by looking at this, you can easily deduce that the average rental yield in Lagos is around 4 to 5% on average. So it means that whatever you're investing in Lagos and you're expecting return, then your rental income most likely will be within 4 to 5%. And I can tell you reasons for this low yield because property prices are actually rising far more than rental income. In short, a lot of people tell me that if you want to make money in real estate, focus on property appreciation and not rental income. That's why most people are moving from annual rent to the daily rent or daily charge. That's where the short let comes in. So a good real estate company that generates above average with attractive dividend yield of 10% is a perfect investment opportunity to earn steady rental income. What does it mean? Now, if I'm looking for a good real estate company right now, first, I want them to generate above average yields. That means their rental yield must be above this region, please, between 4 to 5%. So any real estate company that is giving me 2%, 3%, which is far below the average, then it's a no-no for me because average in Lagos is 4 to 5%. So when you are coming, when you're looking to invest in real estate and you're coming to the market to say, oh, which company am I going to shop for? Now, this will guide you on the kind of company you should be looking at. Look at the company that their rental yield is within 4 to 5%. I will show you how to calculate that using the financial statement of one company that I'm recommending and one company that I'm gradually building a position on. And then once you calculate this, I also want dividend yield to be above 10%. So in the stock market, there's only one real estate company that dividend yield is above 1% right now, and that's the company I'm mopping up. Now, I'm not just buying this company because dividend yield is around 10% plus. I am buying them because they pass all the checklists that you need to deploy when you are analyzing a real estate company for investment and for dividend. So let's move to the next slide. Now, why co-owning real estate is a perfect long-term strategy. Unlike the first model that requires you to buy physical properties, buy land, buy maybe get people on board, like contractor, get necessary approval, like documentation, CFO, building approval, and all that. You will see that this process will take you at least a year before you can get your property up and running and then put it out for sale. And then aside from that, there's still need for you to maintain it. So it's either you want to do it directly or you want to get the facility manager to run it. Either way, you're going to be incurring a recurring cost. So by co-owning a real estate company via the stock market, your recurring cost is zero. So there is no physical involvement in properties or tenant management. Mine is just to go to the market, buy the company share and go do whatever I want to do. At the end of the year, you are going to earn rental income, same rental income that the person that had taken the physical route is. So you might not ask me, what if you want to sell? Yes, you can sell. In short, the owning via the stock market is even more liquid than the physical property. Now, it doesn't mean physical property is not liquid, but when you look at the cash conversion cycle, which is the third point I mentioned here, it takes a longer time to convert a full real estate, a full house into cash. But then if you go through the stock market, you can convert to cash immediately. Now, higher long-term return on investment from regular cash flow, property appreciation, and share price appreciation. So some of you will say, oh, when you buy physical properties, it's going to appreciate for the long term. The same thing also applies when you co-own a property. Why? Because the first model, you are a direct owner. The second model, you are co-owning. So either way, there is still ownership. So if the property appreciates, it's going to increase the value, going to increase shareholders' value in that company. So whether you go through the stock market or you do direct, property appreciation still applies. Now, regular cash flow. Now, by co-owning, the same rental income that a landlord will be collecting from your tenants, you will be collecting that rental income as dividend at the end of the year, because by law, all shareholders of a real estate investment trust are expected to be paid 90% of their rental income. Same thing. Then the other one is share price appreciation. Now, by co-owning a good real estate company, who will come to the market to buy more of that company shares. And as they buy more of the company shares, what happened? The property would appreciate. Sorry, the share price will go up. And if it goes up, you earn another money. So through co-ownership, you have three ways to profit from that real estate company: from regular cash flow as dividend, property appreciation in the future, and then share price appreciation. But then when you go direct, you only have two ways to make money, which is what? The rental income and also the property appreciation. So you can see that through co-ownership, you open up more opportunities to make money, which is three. But therefore, through direct ownership, you only have two. And let me release them again. Direct ownership, your cash flow comes from rental income. Then the money you earn in the future comes from property appreciation. That's in the future, like 10, 15 years. Now, when you go to the stock market, you earn the same rental income via dividend, right? Second part, the same property would appreciate in the future. So by the time the company revalues the property and probably account for the revaluation gain, it will automatically increase their net profit at the end of the year because property value has increased, or when they dispose of the property. And then the third one is share price appreciation, because as more buyers mop up the company's share because they feel that it's good, then the share price will go up, which means you also make money from capital appreciation. That's the major advantage of co-owning real estate versus direct ownership. Now, the third one is high liquidity and low conversion. When you co-own, you can easily buy today and sell tomorrow. If you wish to exit tomorrow or next week, there is nobody stopping you because you're going through the stock market and there are available buyers and sellers in the market. But when you go through the direct ownership, yes, you might have the money to buy, but then when it's time to sell, you do not want to paint the picture. You don't want people to feel that you need money or you are in a haste to sell, so that you don't sell below the property price. You have to wait until you get the right buyer. So the cash conversion cycle of direct ownership is very high. Cash conversion is the time it will take you to convert a resources into physical cash. In real estate, it takes a lot of time, especially here in Nigeria, where there are few people that are getting involved. But when you go through the stock market, the cash conversion cycle is very low. You can buy now and set to sell anytime. There are already made buyers looking to even buy from you, especially when you own a good company. The company I'm going to recommend right now is always on full beat most of the times. Why? Because people see it as a good real estate company. That means you can buy today and sell tomorrow. They are already made buyers. People are already dropping buy order for them every now and then. So that's the reasons you have to co-own real estate. If you cannot start the right way, sorry, you cannot start in a big way by probably deploying billions of naira, you can go through this route. In short, one of the things I noticed that most billionaires are doing right now is they're actually leveraging the stock market to buy up companies. So if you want to buy up a company right now, you don't even need to go to the management directly. Go to the stock market and start placing bids, be buying up shares of that company bit by bit. Over time, you will see that you have actually hit your ownership target. So that's another way to be a part owner of a company. So when you want to invest in real estate and you do not have the capital, you don't have the money to do direct ownership, why not try co-owning? Because you still leverage the same platform, it's still the same real estate. The only difference now is the medium through which you're entering the company is different from the first one. Now, a lot of people like to show that, oh, I own this property, I own this property. Some people, they own different properties without them coming out to brag that, oh, I own this property and all that. So by co-owning, you take advantage of an easier way to be a part owner of a company by investing in their shares. Now let's look at how I select profitable real estate company to invest in. When it's time for me to invest in real estate company, I don't just pick any random company. I don't say, oh, they're into real estate, let's invest in there. And I think this would also work for you if you are involved in investing in physical real estate, all those development company, and then they will tell you bring 1 naira, take 10%, take 100%, take 50% in the next 24 months. This model will help you. Many of us do not ask, we don't do our due diligence. We just believe what we see on paper. Now, by going through this, you would be able to ask for their financial statements. First one, a standard real estate company that wants to collect your money should have a proper record. So you have the right to seek their financial statement, to ask them, can I see your reports? Can I see your annual reports? Can I see your quarterly reports? Even if they are not listed in the stock market, for the fact that they want your money means that you can also demand their financial statement. So here are the checklists. First one is I want to see consistent growth in rental income, net property income, and also the dividend distribution. So this I call it the gross income. This rental income could be gross income. Then the net property income is when you deduct all your operating expenses as a property manager. So how much is left for you? Just like a normal business, when you make money, you deduct your expenses. What do you have? You have your net profit. Then dividend distribution. Dividend distribution is how consistent is that company in distributing dividend. You don't want to buy into a real estate company that will tell you, oh, tomorrow there's no cash flow or our tenants are not paying. No, because dividend is paid from rental income. So if a company has been consistent in distributing dividend, then most likely the company has also been consistent in generating rental income. So here is what I do if I want to run a check on such company. So I will go to investing.com. So investing.com is the platform I use to analyze real estate company I want to invest in. So while discussing this, we are going to look at SFS real estate as a case study. Do you understand? So let's move to the next slide. So I'll be using SFS real estate for this analysis to check whether they pass all these particular criteria. And if they pass all these criteria, then why wouldn't I invest in SFS real estate? So this is one of the real estate companies in the Nigerian stock market. So SFS real estate right here. So let's look at SFS real estate. Sorry. Yes. Yes. This is it here. So as of this analysis, SFS real estate is selling for 111 naira 50. So it's called Sky Shelter Fund. So let's look at them. Sky. Let's look at Sky Shelter Fund. So this is Sky Shelter Fund. You can see here. So these are their property. You can see here. These are their property listing. Here you can see Riverton Court, Sapphire Estate, Bodilon Court Estate at Chevron. This one is at Chevron. These are at Awaya Bejuleki. This is at Osapa Lekki. And then you have your Cromwell Estate. This one is at Chevron 2. So you have Marben Estate. These are Chevron 2, Chevron Drive. You have Victory Crest Estate. This one is at VGC. You have Victory Park Estate. This one is at Osapa Lekki. So you can see these are different estates that these guys own. Now, if they ask you to come, if they tell you to come invest 80 million on this particular property. Now, I know many people can afford it, but then as a beginner, I'm not sure it's something that everybody wants to jump into. Even if you have 80 million right now, is property the only thing? That's if it's your home and abroad, property the only thing you want to buy into. But then it still doesn't mean this property cannot be invested in. You can actually be a part owner of this by going through the stock market. So that means I can actually invest in this company by buying their share. That automatically makes me part owner of this same property that they have posted on their website. You can see, so if you don't want to go to the right of owning physical property, you can leverage on the real estate investment trust. That is by buying their shares in the stock market. So let's look at this criteria. So rental income, net property income, and dividend distribution. So the first thing I like to check is the dividend distribution. Because at the end of the day, if rental income is okay, property income is okay, and dividend is not distributed, I am off completely. So first thing that would make me continue this search is I want to be sure that this company pays dividend. So here I will come to financials and then I will click on dividend. So what am I looking for? I want to look for consistency in their dividend payout. So here this is the dividend history, payment history of that company. So show more. Yes, so this company got listed around 2009. You can see here July 23. No, now you can see that from July 23 into 2024, this company have been paying dividend back to back, back to back, back to back. Can you see right here? This company 2019, 2009, 2010, even 2010, they paid dividend twice. 2011, 2012, 13, 14, 15, 16, 17, 18, 19, 20, 21, 20, 23, 24. So we can see in the last how many years? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. In the last 15 years, Sky Shelter Fund have been paying dividend back to back. So that's the kind of consistency I want to see, which is very, very okay. Now, number two, let's now go to their income statement. So what are we looking for in their income statement? We want to see the gross income. That's the rental income, because all the income you see a real estate company report basically is rental income, while some might come from fixed deposit interest income. So net property income is like after deducting all their operating expenses from their gross income, then what you have left is net property income. So some companies will call it adjusted fund from operation. So let's look at Sky Shelter. Now, on Sky Shelter financial statements, you can see here under revenue, we have 85. Can you see here? 85, 87, 87, and 85. So this is quarterly. So let's expand to annual. Can you see 244, 232, 247, 337. Now, we can even go to Capital Q to see their trailing 12 months if it's being reported there. I like to use Capital Q because Capital Q, let me see the trailing 12 months of that company. So SFS Real Estate Investment Trust. Let's see what their statement is like. So income. Okay, so you can see trailing 12 months. This is exactly what I'm looking for. Trailing 12 months. So 224, 244, 232, 247, 395, and then 408. So you can see right here, this is SFS real estate. You can see the consistent growth in gross earnings. You can see right here, this is what I'm looking for. And then the net property income of that company means you can actually look for their operating expenses and deduct from their rental income. So that one, you can go to their financial statements to find that. So for example, I can go to NGS, then let's look for SFS Real Estate Trusts. SFS Real Estate Trusts. So okay, this is it here. So I want to show you how I calculate the net property income of a real estate company, because this gross income you see here might probably cover both the interest income and also the rental income. So I'm not interested in the interest income, because if a real estate company is earning most of its money from interest income, it's a sign that there's a problem somewhere, because most of its money should be coming from rental income, which is the core operation. So I like to see a breakdown of this revenue. So this is SFS Real Estate. So let's go to now. This is your result assets 2023. Yes, this is it here. So let's look for the annual financial statements here. Okay, this is it here. So you can see that this company reported a growth from 68.9 to 147 here. Now, look at interest income is 68, 147. Profit on disposal of investment property, 57. Now, rental income, this is what I'm interested in, rental income. So rental income increased from 178 to 190. You can see here. Now, this rental income less operating expenses, which is 61 to 77. So 190 less this, 170 less this. So that will now give you what we call the net property income, not the net income. Net income and net property income, they are different. When you do the when you calculate net income is total income of that company, like here, minus operating expenses. This is net income. That when you add all the revenue sources, both from real estate, which is rental income, interest income, profit on disposal, and then you deduct operating expenses, that will give you net income. But net property income is when you look at the rental income alone, that's the income from the property, which is the core business of that company, minus the operating expenses. So like here now, we'll do 178 minus 61. So 178 minus 61 on average. That's one. So this is like an average of 111. And then if I do 190 minus 77.9, so you can see here, so from 111 to an average of 112. You can see from 111 to 112. So I want to see a growth in the net property income. So when you're calculating the net property income of a real estate company, don't assume that is the net income. They are not the same. They are not the same. A real estate company might report a higher net income, and then you might think that the company is doing well. But when you look at the net property income, there might be a problem. So what could be responsible for that? Let's assume that this interest income is higher. So if interest income is higher than the rental income, and then the company will definitely report income. But then this rental income is now, let's say, this is like 45, and then operating expenses is 77, and this one now is almost like, let's say, 100. So you would look at it and say, this company reported higher net income, right? But you didn't see the challenge. The challenge was that rental income, which is the core part of that business, is going down. So the company is only able to patch up its rental income by increasing its interest income. Is the business a finance company? No. If it's not a finance company, you shouldn't be looking at interest income as a major benchmark. So when you're analyzing a real estate company, pay attention to the rental income, because this is what will be distributed. Because by law, you are going to earn 90% of this rental income. So if this is going down, then there is a problem. Then maybe they're having issue with tenants, or maybe their occupancy rate is very, very low. So that is what you need to check when you're analyzing a real estate company. So SFS Real Estate passes all these checklists. Now, the second one is dividend yield versus bond. Now, when I'm looking at dividend yield versus bond, I'm not just looking at a single year dividend. I'm looking at my ability to compound my dividend and then be able to beat inflation and also generate more than my bond yield. So currently, bond yield in Nigeria is currently sitting around between 18 to 19%. Now, what is the dividend yield on SFS Real Estate? So to check the dividend yield on SFS Real Estate, we'll go back to dividend history right here. That's on investing.com. Now, you see that dividend yield on SFS Real Estate is around 14.3%. Look at it here. 14.3%. And guess what? This is the highest in the market right now. This is the highest in the market right now. Even if you go through stock screener, I think you would also find that too. So 14.3% is the highest right now. So SFS Real Estate is actually the highest dividend yielding stock in the Nigerian stock market right now, like profitable. Because high dividend yield does not automatically mean it's a buy. You also need to check other metrics. So as of my check, SFS ranks among the highest with 14.3%. Now back to my slide. Now, when I say dividend yield divided by bond, so one, I want to be able to beat inflation by compounding my return. So by compounding 14.3%, 3 times 1.143 times 1.143 times 1.143, you can see that in the next 3 years, you would have probably made over 49%. That means we're collecting an average of 49%, 1.143, 1.143, 1.143. So when you do that 3 times, so if you can compound in the next 5 years, 43 times 1.143, you can see that means your return would have been an average of 95%. That means you would have been collecting an average of 95% every year. That means by compounding 14% per year for the next 5 years, you can see here, meaning that your return would have grown by, that's the power of compound return in the market. That's the power of compound return. What does that mean? It means that your portfolio would have increased by 95% if you are able to reinvest 14% every year. That means when you collect your dividend from Sky Shelter Fund, buy more shares, collect again, buy more shares, collect again, buy more shares. In the next 5 years, the portfolio would have increased by 95%. That's the power. And 95% will be far more than bond yield and would also be above inflation. That's if inflation is far below it. Now, the next one is property yield versus cost of fund. This is where the research is coming from right now. It's going to start from. Now, Sky Shelter passed the first list, checklist, passed the second one. Now, what is the property yield? Remember, we already discussed the average property yield in Lagos to be around 4 to 5%, right? So we want to see whether this particular company has a property yield below that average or above that average. And now, when we are looking at property yield, we don't want to limit our search to property yield. We also want to check the cost of debt. Now, what exactly is property yield? Property yield is what you earn from that property. And you know what? Real estate company is not totally cash driven, it's debt driven because most of the real estate company, they finance their structure via debts, right? Now, when you collect those loans, you are expected to pay interest on that loan. That's cost of debt. So the cost of debt is your interest on that loan. So we want to look at the property yield, which means if you deploy this money you are collecting from the bank or whatever source you are collecting that money from, and then you use to build the property, the money you're going to earn on that property, is it higher or lower than what you're going to pay back as loan to the debt holders or creditors? Because if you collect 100 million today, you build the property, and then the property is generating 4 to 5% per annum, that's the yield, and then you're paying 10%, 15% on that same amount to your bank. That doesn't make sense. So that's why I like to check the property yield versus cost of debt. So let's look at the property yield of SFS Real Estate Investment Trust. So now, how do we calculate property yield? First one is we look at the rental income. This is the rental income of SFS Real Estate Investment Trust right here. So rental income 190, 178. This is what they have collected as rent. Now, some will say rental income minus operating expenses. That will give you the net rental income, then divided by the cost of that property. So I like to do both end, but then it has to be above average, between 4% or 5%. So let's start with the rental income. Now, in 2023, SFS collected 190. Remember, these are all in thousand. So collect 190 million on that property. Now, if you look through their property value right here, you can see investment property is 1,968,000. So if I do 190 here, 190,026, 190,026 divided by, that's the rental income. What's the property value itself? 1,968,950. So 1,968,950. Now you will see right here that the property yield of SFS is around 9.6%. by 100. You can see 9.6% based on the rental income. 9.6%. You can see right here. That means if you compare the rental income against the property value, is giving us 9.6%. And what did we say is the average yield in Lagos? 4.25%. That's far above. Now, let's now work with the net property yield. So, net property yield would be the property rental income minus operating expenses. So, let me create a new rental income minus operating expenses. So rental income is 190,026 minus what is the operating expenses. Now, operating expenses here is all the cost of running the properties put together, because your actual income is not the money you have collected from your tenants. You also need to account for your expenses. So 77,916. 77,916, 77,916. So we'll call this the net property income after accounting for all the operating expenses. So that will give me 112,112. So let's go back again. So that will now be 112,112, 112,112 divided by 196. So that's to give me 5.96. So both the rental yield and the net rental yield, net rental yield is around 9.6. Net rental yield is around 5.69. So as long as both are above our average of 4 to 5%. So average is 4 to 5%, and this company is generating 5.69, which is above average. That's an excellent company. That's an excellent company. Now, we are not just going to be rejoicing and say, this company rental yield is above the average. Now, what is the cost of debt of that particular company? What's the cost of debt of that company? Now, the cost of debt is when you compare the interest expenses of the company against the debt position of that company. So the cost of debt is the interest expense of that company against the debt position. So here we are looking at the interest expenses of the company. So let's look at the cost of debt. Now, on the company's book, do we have anything like interest expenses right here? Can you see right here? Do we have anything like interest expenses? No. Because ordinarily, when you see interest income, now this interest income right here, let's look at the breakdown on note 4. Let's see if it's the net interest income. Note 4. Note 4. So you can see here, fixed interest income, interest from unclaimed distribution, profit on disposal, rental income. So we don't have anything like interest income. You can see from the operating expenses, manager's fee, other expenses, audit fee. So there is no interest expenses right here. You can see here. So on the company's financial statement, there is no interest expenses. That automatically tells you that SFS is not exposed to debt. So even if you go to the balance sheet right here and look at the liability here, the liability of the company is made up of just payable and accrual and deferred income. This is just the liability right here. So we are not seeing anything like non-current liability as if the company has borrowed. Now, that automatically means that this company is funded fully with shareholders' equity. Shareholders' equity, you can see here, and the cash generated. So there's nothing like debt, and that's a huge plus for this company. So property yield of 9.5% or property yield of, let's say, you can even work with 5.65, which is above average, versus cost of debt of 0. You can see here, cost of debt is 0. Cost of debt is the cost of borrowing, while property yield is around 5%. So imagine this kind of real estate company generating huge above average return of 5.65 on its property, and cost of debt is 0. So that's a plus for me as a shareholder. So that automatically means that most of the rental income are coming to me as a shareholder, because if this company has debt, it means that they will have to deduct that interest on the debt from the rental income. So that leaves me with lower return. So that's why net property income is very important. But then, as long as property yield is above the average yield of 4.5%, then it's okay. Now, if you look at the research, you will see that majority of the company's property are on the island. And then from my research too, you also find that you will most likely earn higher when you invest on the island compared to mainland, as far as property yield is concerned. You can see rental yield on the island is around 6%, 5%. Then if you come to the mainland, it's around 3 to 4%. So this is actually okay and very nice. Now, what is the debt to assets of that company? Now, this company doesn't even have debt at all. So that means the debt to asset is less than 40%, which is very, very okay. Now, what is the interest coverage? This company is not even exposed to any particular interest obligation, because from the financial statement, as you see right here, there is nothing like interest expenses right here, because interest coverage would have been earnings before interest and tax divided by interest expenses. So, but here the company doesn't have any interest expenses, which is very okay. So that would most likely be far more than 3. Very, very good. And then tenants and occupancy rates. This is also very important. Don't ignore this, because your rental income is tied to tenants and occupancy rate. If a company has higher occupancy rate, most likely rental income will be higher. But if occupancy rate is lower, then rental income will be lower. So SFS also has a report of key performance metric, where they detailed out all the properties and also their occupancy rates. So this is the key metrics right here. This was posted April 26, 2024. That's around first quarter to this year. So this, I like to look at this report, because by looking at this report, you can easily tell the properties they own and what the occupancy rate is like. Now you see each of the property I mentioned: Victory Park, Milverton Court, Sapphire, Bodilon, Cromwell, Marben, which you saw on the company website. You can see that the occupancy rate is 100%, 100%, 100%, 100%. Now this particular one that is zero is under construction. So if a company can undergo constructions and in its book is not carrying any debt, what does that mean? It means there is tendency that this company would pay more dividends, because by the time it completes this and is able to give it out and earn rental income, what happens? They will distribute more dividend to you. So for me, this is actually another reason why I should buy SFS real estate, because by the time they complete this particular property, rental income will increase. Now, you can look at the average yield on each of the property: 9.6, 8.3, 7.25, 7.72, 4.3, 5.5. Can you see the current yield on the property? And then look at the average yield on properties on the island, like I shared with you. So this is very high. Can see Victory Park is earning as high as 9.6%. And I've already explained what the yield is: rental income divided by the cost of property. So the average of all this is giving us around between 6% to 7% on average. And then look at the tenants: individuals, individual, we have corporates, we have individuals, individual, under construction, individuals. So these are most likely residents and apartments. Can you see a resident and apartment, resident and apartment? This corporate might probably be resident and apartment for the company's staff. And then you can see the age of the property: 15 years, 11 years, 12 years. Now imagine the age of the property right here. So that's to tell you that this is one long-term investment you can embark on, because the age of each of the property is at least above 5 to 6 years. Then one is even up to 15 years. Now, being a part owner of this kind of real estate company opens you up to what? Rental income at the end of the year. Then you collect your rental income as dividend. Look at the length of tenancy: annual, 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 annual. So as long as the occupancy rate is 100, you can see here, and they are collecting their rental income back to back, you are so assured of collecting your dividend every year. And then look at this other information here: net asset value, almost 2.5 billion, 1 to 3 years. Then property type and distribution, this is the occupancy rate. Then delinquency rate on rent, just low at 2%. So this is extremely important and is very good when you are investing in real estate company. So here, this company passed this checklist. Now, what is the fair value estimate on Sky Shelter? What is the fair value estimate of Sky Shelter? Now, for a real estate company, we use what we call the net asset model. When you want to value a real estate company, you use the net asset model. What's the net asset model? The total assets minus the total liability. That will give you the net asset, then divided by the number of ordinary shares of the company. So as at 2023, total assets of Sky Shelter is, let's look at total assets of Sky Shelter is 3.3, all in thousands. So this is 3.3 billion. And then total liability is 706 million. Then look at the net assets right here. Net asset is already 2 billion 593 573. Now, net assets per unit. This is it here. Net assets per unit. That means when you divide this net asset by the number of ordinary shares of the company, this net asset per share is 129. That means the minimum amount this guy should be selling should be 129 naira per share based on the net asset value. And what is the price in the market? It's around 101 or one is I think around 101 naira. Look at it here, 101.4. And then net assets is around 129. So that means this company is 129 minus 101. That'll give me 28. 28 divided by 101. So this company is 27% undervalued. 27% undervalued. That's interesting thing about this guy. Is 27% undervalued. Now let's look at note 10. I want to show you something very important under note 10 of this company's financial statements. Note 10, note 10, note 10, note 10. Note 10 of this company's financial statements. Let's see. Note 10. Yes. Now, I want to show you something. Now, based on the existing report, remember the particular value we see on the company financial statement, that the value of the property, they are at cost. They use the cost model, at cost model, not at market price. It's at cost model. So the value of the property, investment in properties, look at the Keja GROA, Victory Park Estate. I think they dispose this property, that's why it's zero. Then Victory Park, Sapphire, Bodylon, Miverton, Cromwell, Mabel, Victoria Estate. Now, all these were at costs. Now you can see here, the cost model is used in measurement of the investment properties. Now, at cost is the cost of building that property. The cost of building or putting up this structure, that's what's giving us 1.9. Now, remember, this particular property has a fair value, which is the market price, because the company is not going to sell them at the cost. They will definitely want to sell them based on the fair value, and that requires them to get an estate valuer. Now, look at this comment right here. Look at this important comment right here. So the cost model is used in measurement of investment property. Now, the property, let me go up a little bit. Now, the properties were valued at 2.6. Can you see here? Were valued at 2.6 billion, inclusive of disposed property, that's 2.8, and 435 by Emeka D. Etel. You can see here of Ubesi and Co. This is an evaluator, an estate surveyor. You can see in their respective period, in their reported dates with March. So this actually tells you that this property is worth more than this right here. This property is worth more than this. You can see property were valued at 2.6 inclusive of disposal versus 2.2 in 2020 and 435 million. Can you see here? So what does that tell you? You can see the valuation here. You can see here, report assets this. So the value of each of the property has moved. Like here, this one moved from 365 to 660, 132 to 180, 360 to 459, 385 to 950, 950. So this is the real value of the property, which is 2.68. So if we're to account for revaluation gain on this property, which is 2.68 minus 1.96. So 2681 minus 1968. 2681 minus 1968. That means we have a revaluation gain of almost 713 million. Now, if I'm to go by the record, this 713 million, if you actually added it to the P&L of the company, the P&L of the company, that is 713. If you come back to the P&L here, yes, and you add it as revaluation gain, that means total income should be a lot more higher, and the net income will be a lot more higher, and dividend distribution will also be a lot more higher. So that tells you that if the company decides to dispose of the property, that is when they are going to recognize profit or loss on disposal. So a real estate company report at cost. It's when they now dispose the property that they will now report the profit on disposal. So if they dispose any property and they make profit on it, you can see the company is sitting on an unrealized gain of 713 million, which is not reported in the book. So if this company decides to dispose of all property, that's exactly what they are going to earn. But then they will not dispose of, because that's where they generate rental income. But the idea is to let you know that whatever you're paying right now is extremely lower than the fair value, because this automatically increases the profit. And then when you calculate the net asset value should be sitting at least around 130 to 150 naira per share in the future. So if you're able to account for the property that have appreciated by 713, it means that SFS real estate should be selling for at least 130 to 150 naira per share, compared to the current price of 101 naira. So that, what does that mean? It means that this particular company is grossly undervalued at the current market price. Now, by investing in this company, you collect an average of 14%. 14%. Now, if we look at the dividend history, this company has consistently paid dividends. And if you look at the yield has been rising from 4%, 5%, 7%, 8%, 10%, 11%, 9, a dip, and then 10% again, and then 14%. So you most likely see a consistent growth in not just dividend, but also dividend yield, currently at 14.3%. So if you're able to compound this in the next 5 years, your portfolio would have increased by 95% on average. So this is one company you can invest in aggressively to be able to earn rental income if you are looking to invest in real estate. So I hope this video is explanatory enough, and I hope this video has opened your eyes on how to invest in a good real estate company. If you like this video and you want to get notification on more videos like this, or what to buy in the stock market, kindly hit the subscription button and turn on the notification bell, so that when I release more videos on stocks to buy, you will be among the first to get notified.